Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets that are having serious plumbing problems. We'll talk about that today. I'm your host, Steve Van Meter, and today's big topic is, can Wall Street bets crash the markets? Now, I'm not going to go into the whole detail of how all this is functioning, but I think there's something bigger that could happen. I'm not sure they realize it, but I wanted to share that with you. We're going to talk about what's going on with Wall Street bets. Does it affect my thesis at all? Could it lead to a liquidity event or insolvency event? The answer is yes. We'll get into that. Yes to the second half. No, it doesn't really directly affect my thesis at all. Why aren't bonds rallying? Good question. I got an answer for that. We'll look at the credit data. We're going to look at some charts. We've got economic data. And some of you have said there is a Bond King confidence index that if I am wearing the crown for the whole show, or depending on what percentage of the show, it shows my conviction in the bond market. And you will notice there's some upgrades. My wife and head prop master has heard your call and added some jewels to the crown for this week. And probably next week, because I'm not going to take them off. All right, so what's going on with Wall Street bets thing? Let me quickly summarize this. Now, if you're really curious, there are plenty of videos and articles written about it. Just go take a look, and you'll get a more in-depth view. But here is the short story and how that can actually lead to a market crash, which I think is really interesting, because no one actually would expect that these small speculators have much power, but yet they're so smart that they figured out how the system works, and even more importantly, how to exploit it. So what the setup is, you have some large hedge funds that have been short some very thinly traded stocks that are not traded widely to begin with. They don't have a huge float. And even worse, and I'm not sure that the Wall Street bettors knew this, is they had borrowed money to place those shorts. And so someone who understands how the system works had a really, really great idea. And that was, let's go buy a bunch of long-dated, out-of-the-money call options on these stocks with massive short positions that are fairly, they're not very liquid in terms of, their positions. And let's force the dealers to hedge. Now, what does that mean? Well, when you buy a long out-of-the-money call option, the securities dealer, has to buy the physical security, the stock underneath, to hedge that position. So what makes it interesting is that call options are a leverage play. And so these small investors who didn't have enough capital to actually directly buy the stock to push back the hedge funds started buying a bunch of call options. And they started squeezing. Now, why would that matter? Well, because it gets really interesting here, because if you're short a stock and it starts going up, you lose money. And if you are leverage short, you're losing even more money. And if you borrowed the money to do your leverage short, well, you're going to look like a massive fool. Because at some point, if that stock goes up enough, here's the game, right? The Wall Street bettors were just planning on driving the stock price up enough to force these hedge funds to become buyers at a much higher price where they could exit and take a profit, which is pretty darn brilliant. Until I think they found out that these hedge funds were buying on margin or with debt. And they started getting margin calls. And then one the other day needed like a $2.5 billion bailout. So that's pretty interesting, right? So how does that correlate to the broad market? Because some people ask, well, Steve, why don't they short the bond market? Or why don't they go long the bond market or go long the VIX? It's too big. The bond market's way too big for them. I mean, look, I'd sure appreciate it if they could, but it's too big. And so is the VIX. It's too big. They don't have enough buying power to do it. Now, they might someday, but they don't now. But what I'm not sure they realize is the power they have over the markets right now, that you can almost see a sort of a regime change from these big, powerful hedge funds to these small speculators that no one really cared about. Because what's happened right now is the market is fairly illiquid. You've heard we talk about that. And what that means is there's not a bunch of cash, which you would think there was because of all the money that's showing up in deposits in the M2 to flood into the market and provide liquidity. So the market's rather illiquid. And because the market's rather illiquid, as these Wall Street bettors are squeezing these hedge funds are looking like they're going to blow up, right? So what do they have to do to cover those short positions if they need to get out of them or want to hold them? to cover their margin calls even. They have to go sell something else. And they go sell something else, say stocks, other stocks, and they're selling it into an illiquid market. And that brings volatility up. So we see volatility. Where's my bullish thing? Volatility goes up, and then stock prices go down. Now, what's interesting is the market's becoming so illiquid that it may not take a whole lot more from this group, depending on how far they can push this, to trigger a massive sell-off in the equity market, as volatility is just sitting really at some levels here that if it breaks through, it's going to trigger a massive amount of selling. Which, of course, would be negative for the stocks that they're speculating on. But hey, if they're smart and fast enough and they appear to be extremely creative and have a fairly good understanding of the system, maybe they can get out with their profits fast enough. I don't know. But nobody would have thought that these people who are behind this, which, by the way, I think is completely brilliant that they had the foresight to do this. Some people have asked the legalities of it. I'm not the right person to ask about that. But what I will tell you is they may have more power than they realize. And with that, they could crash the whole market. So how would that affect my thesis? Well, if you have an illiquid market, right, and it starts to break down, crumble, well, then we'd have another liquidity event like March. Well, bonds do really well during that time, which would be great. I mean, I would have no issues with that at all. Now, some people, well, how do you know that bonds aren't going to crash? Well, you do remember in March, they went way up first. That's called the Bond King exit, because we're going to get into all these players that don't own bonds here in a little bit. So could that trigger an insolvency event? I don't know. It's entirely possible, and I talked about this on Martin North's show, I think it was the other day, is how could this play out? There's two likely events. One, we get a liquidity event, right? Stock prices crash. It becomes, I'm looking for my arrow, a huge buying opportunity, because then all of a sudden the Fed floods, with a bunch of QE, and then stocks go up again. As long as there's no defaults that occur from that. It's possible there won't be, which means there could be another massive rally coming before the insolvency event. It's also possible that a crash in the market could trigger a bunch of defaults and then it's game over. Don't know. But all I know is opportunity is knocking on this door. And the Wall Street bettors I don't know if they know, but they're so close. If you look at the VIX, let's go look at this. I wasn't planning on looking at the VIX immediately, but let's go look at the VIX. And I apologize the show's so long, because I'm going to be long, because I think this is a really interesting topic, is you see the VIX is sitting at a level that if it gets much higher than, say, 37, between 37 and 40, you're talking a massive unwind in the market. A massive unwind is coming that possibly could take the VIX to higher levels than it was in March, because everybody's long the equity market right now, and the market is rather illiquid. I will look at that in a little bit when we talk about GDX. So one of the questions that comes up is, why aren't bonds rallying? Because the market's selling, shouldn't that mean the bonds go up? Well, there's a couple of problems. One, the market's illiquid, so you see people selling things they don't necessarily want to sell to get money out. And as Travis Kimmel posted on Twitter when that question came up just right before I recorded, he's at Colorado Travis, he said, it's people moving from savings to checking, right? That's exactly it. I'm going to sell my bond to get cash to cover my positions, because maybe I'm getting margin squeeze or some other things, and I got to cover that. So I'll sell what I can sell, which is liquid right now, which is bonds. I can sell them. If I sell more stocks, it might cause further volatility, might cause further problems. So really interested in the VIX, because this thing can blow up. Now, if you understand how a lot of the products in the marketplace work, you'll realize that everybody's long the equity market and they're either neutral or short the bond market. So let's kind of quickly walk through this. We talk about the CTAs or quants. They are max along the equity market, and a lot of their positions aren't selling until the market comes down quite a bit. So they're holding their positions. We know on the bond side, they are net neutral, and possibly some of them are actually short the bond market. So they're already there. They're not buying right now. There's something called volatility controlled products. And these are pretty interesting. And the way they work is, if volatility, which we'll use as a bearish arrow, if volatility is falling, now these are pretty interesting, they adjust their allocation and pick up more stocks. So think of it as your traditional asset allocation portfolio, but the way it works is it's dynamic. As volatility falls, instead of say being a 60-40 equity portfolio, it can become an 80-20, 90-10, up to even 100% equities. Now, these aren't at maximum equity positions, but they're fairly high equity positions. And the way they work is based on their formula that looks at the change in volatility, which is why this is interesting. The longer volatility stays higher, the more of these things trigger a sell signal to reduce their equity exposure and go back to a normal allocation. Now, they can also go the other direction. So if you're in a 60-40 risk parity portfolio, normally it can increase its equity exposure, but it can go the other direction too. It can actually go below 60% equities and pick up more bonds. If you've owned a variable annuity in the last 20 years, you might actually have, your product might actually work like this. So these things are fairly long equities and haven't really hit a trigger point yet, but the longer vol stays up, more likely that's going to happen. You look at risk parity portfolios, they are net short the bond market right now. So they're not buying. You look at other sort of momentum programs, which there's so many different strategies and they're all fairly momentum based. They're short or out of the bond market and nothing's there to trigger all this buying. But if you get volatility to go up enough, what will happen is these programs will mechanically sell. They are agnostic to the economic data. They don't care. And they don't, if the more vol goes up, right? If vol goes, boom, the more they sell, and they're going to sell into a bond market that doesn't have a lot of space for them, meaning prices are going to shoot up, which is exactly what happened. If you go back and look at what happened in March here, we'll zoom out a little bit further. What happened here is people were chasing the bond market up. Strategies got chased into it and just massively drove prices higher because they weren't in bonds and their strategies were long equities. That will happen again. So when people say, well, gosh, this is so terrible, nobody wants to own bonds, the answer is nobody owns bonds. And all of these strategies were designed to control risk, and I don't think they work very well at all. You think about a vol control strategy. When is it going to have its maximum equity exposure? When the VIX is at its lowest, pretty much. Well, when do you probably don't want to be in max equity exposure? When the VIX is at its lowest. But that's what stuff's out on the market, and that's why we're seeing people there's not a lot of demand for bonds, and we're seeing selling pressure here, as we saw in TLT today. We'll go look at that real quick because people need money, so they sell bonds. So look what happened. You had this overnight selling for the second day in a row as people look to get out. And then prices rallied up nicely, and then all of a sudden hammer selling. And you notice it came right back down here as insiders were likely testing to see if there's demand here. Found it. More selling, demand there, and all of a sudden it's boom, off to the races. And there you go again, because there is a demand, but it's not from all of these other strategies. So you think, why are these large commercial banks long the bond market? Why do I call myself the bond king? Because when all this money floods out of these products that are sitting in equities, they're going to come into a market that the bond market, there's not a lot of space for them. The demand is soaked up. The commercial banks are long the futures market. The Fed is buying up the supply of them. It makes perfect sense. All right, let's get into the economic data. You want to talk about liquidity? All right. Let's go look at GDX. I want to cover this more in detail on the Sunday show. So I'll give you all the meat early and see if you stay for the rest of the show. So here's what GDX is: a great proxy for liquidity. And I've been saying for a while, and this is gold bulls totally are shaking their head. I'm wrong. Buy the dips. I'm telling you, we'll get into this in more detail. You see a beautiful head and shoulders pattern on GDX. Now, if you follow gold, you got to remember the miners lead the metal most of the time. So if the miners are selling off, the metal will follow. You have a left shoulder, head, right shoulder. Your proper neckline is this angled Cayenne line. You see that here. This is it. Now, what does that all translate to? If this breaks down here, these people become sellers, and these people become sellers, these people become sellers, and the floor drops out. Why is that a problem? Well, if you overlay the S&P 500, you will see why GDX falling is not a positive sign. So here we are on, this is a 2-year chart. And we see here the equity market's up, GDX is leading down. You see somewhat of a relationship here. Zoom out. What do you see in here? GDX crumbles right before. It's not following up. S&P up. GDX flat, starts to roll overhead down, pulls the equity market down. And you can see here, GDX down, equity market down. And I'm sure we can go find some other places. Here, GDX down, equity market down. Where are we at? We're not even at 2008. Where's that? Let's go find that. Here, 2008. Equity, GDX down, equity market down. GDX is a proxy of liquidity. What's between these two orange lines? This is called a supply zone. This is where the big buyers were at. If these buyers have sold all the way up in here, this falls to the floor. Now, how do you measure this move? Again, we'll look at this more detail. Is you pretty much take a mirror of the neckline, which I'm using as this dashed purple line, and flip this over. So this top becomes the bottom. That means the bottom for GDX is somewhere between $16 to $17 a share on a measured move. I know, pretty crazy, right? If we zoom out a little bit, what do we see for support as 16 to 17? Well, not a whole lot. We've got this and not much over here, which tells us, you got this spot right in here, that if that breaks down and doesn't hold, your real support becomes back at 12 to 13. Now, if you're wondering what that beeping noise you hear in the background, beep, 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 yeah, that's the moving trucks backing up to the castle. So if that happens, which I think it will, I don't know if it gets down to 12, but if it goes anywhere down in that range, you're going to hear some moving trucks at the back of the castle because we're loading up all of our bond profits at that point. And we're going to take over a new kingdom. That's how it works. GDX is telling you there are problems in the system right now, and it is not good. There's your liquidity proxy. Let's get into the economic data. Because this video is going to be way longer than I anticipated, but I hopefully you find it of value. Retail sales out of Japan year over year. Here's your pent-up demand in Japan, 0.6%. Last month's negative 0.3%. Contraction in retail sales despite all the massive monetary easing around the world. Let's see anything interesting in the Eurozone. Consumer confidence unchanged at minus 15.5. Let's keep moving along. German CPI preliminary. Hey, a little bit of inflation coming in Germany. It's minus 0.3. So it went from deflation to preliminary plus 1 on the CPI. How about the U.S.? We got jobless claims. Now, this is not inflationary. So you've got initial claims came out at 847,000. The 4-week moving average is just shy of 900,000 at 868,000 jobs. You know, there's this odd belief, and it makes no sense to me, that people are going to lose their jobs, go home, and go out because they have free time now. Hey, I don't have to go to work. I'm going to go spend a lot of money. Now, people that believe that have never been unemployed and in a job market where they don't have confidence they're going to get back to work. So unemployed people, not inflationary. Now, 4-week moving average, if we hit another near 900,000 number, is going up. Look at pandemic claims coming back. Some, as we kind of talked about, some of these claims are fraudulent. Some of these claims are going to come back online. Total claims up almost 2.3 million to 18.2 million on unemployed benefits. Not inflationary. All right, looking next, we've got personal consumption expenditures, another gauge of inflation. This is one of the Fed's favorite ones. So here it is, personal consumption expenditures sitting at 1.3%, 1.28, not inflationary at all. I mean, so if you look at, the Fed's target is 2%. Where's that? That's up here where my mouse is. Nowhere close. Again, good news for the bond market. No inflation there. Let's see, new home sales up 1.6%, missed expectations. We're seeing some slowing down there in December. U.S. leading index month over month is 0.3. This is stall speed. This is telling you the economy is headed lower. In fact, this number is only up because of the equity market component in this index. If you strip that out, it's actually negative for December. How about Kansas City Fed manufacturing index? I was going to look at this in more detail, but due to time constraints, we will skip that. Went from 12 to 22, so an improvement in the manufacturing sector in Kansas City. The 7-year note auction was okay. I mean, it came out pretty good, but not a huge demand, but where the demand was good. Industrial production out of South Korea up 3.4%. So expansion going on, industrial expansion going on in South Korea. Retail sales went from negative 0.9 to 0.2 on month over month. What else? Tokyo CPI January still deflationary, went from, although improved, from minus 1.3 to minus 0.5. So you're seeing a little bit of inflation, but not a lot. Let's see what else we've got of interest here. Spanish CPI preliminary flipped from deflation to inflation at plus 0.6. So again, we're seeing a little bit of inflationary pulse coming around. Italian producer prices still deflationary at minus 1.8%. Let's get into the U.S. data here. I already did the PCE price index. How about this? Personal incomes in December up 0.6. Personal spending in December down minus 0.2. People are becoming savers, and the reason is because they're not confident about their employment. Now, Chicago PMI, this is pretty interesting. I actually want to look at this one. Chicago Business Barometer jumped, but there's some interesting things in here. So this is saying of the 63.8 is a solid number, but look, production surged 9.9 points in January, highest since January 2018. And demand picked up. New orders surged. Well, that's good, right? Highest level since November 18. Order backlogs. You want to talk about what inflation comes from? Order backlogs. Now, if you're not sure how that works, imagine you run a factory and you get to work and you got a big pile of back orders, and then you get a fax machine or whatever's whirring emails. Oh, I got a bunch of new orders. So what do? Raise prices, because you're seeing too much demand. You raise prices. That's where you see inflation. Now, this is interesting to me. Order backlogs grew for the third consecutive month, and it's been in expansionary territory since September 2020. Now, you look at this so far, and you're like, man, new orders are up, order backlogs are up, production's up, and this is awesome, right? Until you get to the next one. Inventories continue to rise. So inventories, what they have available to sell, highest level since October 2018. Whoops. See, we have a potential here that we could have an inventory recession again, because everyone said there's all this pent-up demand. And so the factory sector, the retail sector started to believe it, and then the wholesale sector started to believe it, and that means the factory sector is believing it because everyone's ordering, because everyone else says there's all this demand. And then you look at, and what do you see? Right here in the data. Where was it? Personal spending down minus 0.2%. Whoops. So employment even slipped. So despite all of this other numbers that look good, factories are reducing. It looks like they reduced their employment a little bit for the recording a 19th straight reading below the 50 mark. So they're reducing their employees in the Chicago area, perhaps as they believe that inventories, if they're not sold, are going to lead to a cancellation in new orders and perhaps cancellation in backlogs. What else do we have? Inflation expectations and Michigan consumer confidence. Really not much of a change in the preliminary consumer confidence. But how about inflation expectations, which are showing here? They too were unchanged. All right, let's take a look at the assets and liabilities of all commercial banks. And if you want to see some ugly credit data, this is it. Bank credit up $15 billion. So far, that sounds good. Securities and bank credit were up 28. That is, now you see the problem is the banks bought $28 billion in bonds. How's that broken down? $23 billion in mortgage-backed securities and almost still shy of $8 billion in U.S. Treasury securities. Looking at the rest of the data, loans and leases down $14 billion. Oops. Residential real estate contraction. This is in contraction. It's about to take the whole real estate sector into contraction, down $14 billion. Commercial real estate up $3 billion. That 3.6. That's impressive. Consumer loans up $1 billion, but credit cards are down. So it looks like car loans are up a little bit. What's growing the fastest on the bank's balance sheet? Cash. You want to talk about what is not inflationary? People holding cash. All right, on to the PowerPoints. I know, overtime here. On to the PowerPoints. M2 money supply, 12-month rate change, 26.82. It's starting to fall a little bit. 6-month rate change is at 7. 3-month rate change is short of 4. What is actually going on under the money supply? What's interesting is almost unchanged. Almost unchanged, up $10 billion. Which is nothing for the money supply. So you had that one big weak burst, which maybe be the stimulus checks, and now flat. That's interesting. Savings deposits are up. Checkable deposits are down. and institutional money funds. Looks like some people move some money into cash. That to me is interesting. Remember, the money supply is supposed to just skyrocket. It did for 1 week. Here's the real estate loan growth, total real estate market. Growth rate's down to 0.8% from a year ago, almost about to contract. 6-month rate of change is at minus 0.4. 3-month rate of change is at just shy of minus 3. Looking at commercial industrial loans, which will go negative in March some point. Growth rate is down to just 9% from a year ago. The 6-month is rising, but that is negligible at just shy of minus 10%. 3-month rate of change is just a little more than minus 4.5%. And it's falling. How about loans and leases and all bank credit? Looking at every loan across the board in commercial banks, growth rate down to 2.91%. Normally we don't see, this is end of recession territory, not in recession territory. Now the last two indicators are rising. 6 and 3-month rate change are rising, but we're talking like 0.1% or less. 6-month rate change at minus 228. 3-month rate change at minus 1. You want to see consumer pent-up demand? Well, you're not going to find it on this chart. Consumer loans and credit card growth rate as consumers continue to deleverage, down minus 12.6% from a year ago. There's your pent-up demand. There is your V-shaped recovery. And then last, you know what? We don't have time to talk about the bond market. I thought we would. We'll have to talk about it on Monday because I want to show you that this backup in the 30-year is really nothing to be even concerned about. When you understand how 2-year yields and 10 and 30 years play together, you'll totally realize that a backup in yields, if you can stomach it, becomes a buying opportunity. And if not, you wait till you get a little bit clearer signal. Anyways, I'm Steve Van Meter. Thanks for staying with me so long. I appreciate that. We'll be back on Monday. I'll be sure to talk about what's going on in the bond market because this, and we'll cover more on the Sunday chart show. I think what we're seeing is some pretty interesting indications that we're very close to seeing a bottom put in. Have a great weekend. Bye now. The content of this video is provides educational information only, is not intended to provide investment or other advice. Shows not to be construed as recommendation or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Meter. Personal capacity opinions expressed in this video that I do not reflect the view of Atlas Financial Finance Inc. or Steve Van Meter Financial.